Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Earls and Eric DiNicola. They are real estate investors who purchase and syndicate large multifamily properties in the Southeast, while also developing luxury multifamily condominiums in the Boston market. So thank you so much, guys, for being on the show.
Thanks for having us, Charles.
Thanks a lot.
So it's usually we'll have guys on the show that have, obviously everybody has a different background, but it's interesting that we'll drill down into your development and also syndication, because it's usually you're in two different markets, right? So we'll get into more of that. But before, give us a little background on both you guys, personally and professionally, prior to getting involved in your development and syndication businesses.
Yeah, so Eric and I have actually known each other almost 20 years now. Met each other when we were in high school. Did a lot of team sports, football. We were on the powerlifting team. Played a lot of competitive video games when we were kids. So good teamwork between the two of us. Kind of had that rebellious streak. Didn't want to work for someone else. Wanted to kind of carve our own destiny. We knew that from a young age, but we didn't really know. Just kind of a vague idea. Hey, maybe we start a company someday. Went our separate ways for a few years, went to different colleges. I got my real estate license, and I kind of saw that as maybe this is the opportunity. I was selling smaller apartment buildings for a couple of years in Massachusetts and Connecticut. And I saw the way an investor looks at real estate. I actually come from a construction background. My father's a contractor. My brother's a carpenter. But I don't really like construction. I don't like the nuts and bolts of it. I don't really have, I don't have the skills for it either. So I always thought I wouldn't be involved in real estate, but I saw the investing side of it as really actually quite interesting, because it gives us exactly what Eric and I have always kind of wanted, is financial freedom and basically security is the way we define it, is being able to have passive income, have assets that are ideally increasing in value, but most importantly, providing you regular income. So we had this idea, let's buy a rental property. And we were saving up for a couple of years. And during that time, while we were saving up money to buy our first rental property, I actually noticed that the condominium market in Boston, where I live, is very, very strong. You have basically, it's either the number one or the number two, depending on what list you're looking at, but it's the number one or the number two life sciences city in the country. The other one in contention, San Francisco. And you have a lot of biotech firms. You've got the vaccine producer, Moderna's right in Cambridge. You've got a lot of really highly educated, well-paid employees moving into the city from all over the world, all across the country. They're moving here, but they're moving from other countries as well. And that has caused the population to really skyrocket in Boston. We already surpassed our projections for 2030 population a couple of years ago. So it's been growing faster than was expected. And the people who are moving to the city are high income people. So what this does is it makes the luxury rental space is very strong in Boston, but additionally, there's a demand for people who want to be homeowners. They want to own condos. They don't want to own a single family with an hour commute. They want to live right in the city. They want to have access to public transportation. So in 2015, we purchased a two-family, which was in a three-family zone, and you could convert it into 3 condominiums, which we sold. And that's been one of our main focuses of our business ever since. We're doing a couple different things now, but condominium development has been our bread and butter since 2015.
Awesome. Yeah, very highly educated. I think it's like you're like within a mile of certain parts of Boston, there's like 80 institutions of higher education. So I don't know where else in the United States and or the world you have that.
Absolutely.
That's right.
So Eric, what's your background prior to getting involved?
Well, I mean, as Nick said, we've been friends since we were in high school. And we always had this idea, and our personalities were similar. Back then we were always, kind of pissed off and going to school and, trying to not have to wake up at 6 a.m. and do all, but we definitely had a strong bond at that point, and we knew, okay, this is what we want to do. And Nick sort of gave you an idea of kind of that first project. Coincidentally, there was, all these institutions you talk about in Boston, and I ended up going to college in New Jersey for some reason. Even though what you just said is very true. And so anyway, it was several years after that. I was working in public equity and then private equity in New York City, and I always joke, it's like the first minute I sat down on my first job out of college, I knew there's no way I can do this. Like 9:01 on the clock, I said, this is not happening. So anyway, Nick had this idea. We saved up for a while. We got into that property back up here in East Boston. I had to move back up here, which ended up being great. And so, we've been at it with our company now for a little over 6 years, 13 projects we've done. We have several right now in the pipeline. So we sort of started off with that condo thing. I had a finance background. So Nick brought his real estate background. We kind of morphed these two things together to the point where now we're both just very fluent in everything. There's really no division of skill sets. We definitely both have certain strengths and weaknesses, but we really complement each other very well, work together very well. And it's not even really like a yin and a yang thing. It's very, together, combined. We've brought in other people, another friend of ours, Kyle, we brought in to help grow the business. He works with a lot of the investors and helping find deals. But we got to the point where that first deal kind of propelled us in East Boston. It was a by right deal. So we didn't actually need to get any zoning approvals, no variances to do the third unit because it was in a 3-family zone, as Nick already mentioned. So that was kind of a eye-opening thing. We said, okay, this really works. What you found here, man, this works. This is something we can continue to do. This is a model we can set up and sort of scale up. That was 2 to 3 units. Then, our next one was a 7-unit and simultaneously a 2-unit. So, you think, okay, the 2-unit may be smaller again, but those are very high-priced units in a submarket right outside Boston, another city. So that gave us the ability to do 2 projects at once. And then from there, kind of, we hit the ground running, and really just used all our skills, our background, and said, okay, we have a new focus here. We have a real good idea of how to build this model out. And we stuck with it.
Oh, interesting. So let's talk about what you guys are doing now with your current investment strategy. Well, you can start off with your criteria, what you guys are working on with syndications and how you got involved in the syndications. And then we can kind of circle back to how you manage that and how you kind of put both firms together so that you have your development arm, where you guys are living in the Northeast, and then also where you're also investing, I think, throughout the Sun Belt. So give us a little background on how you guys got involved in syndications.
Yeah, so it's kind of a natural evolution for us. We started off with all our own capital into our development projects. And there's a lot of, people who live up here, they understand the real estate market's really hot. So there's a lot of people who are interested in investing. Most of them are local. There are people from out of the state too. I think people from out of this region, everyone's hot on the Southeast. We were too, and I can get into that in a little bit, but this is actually a very strong real estate market that's a little overlooked, I think, because of some of the unique characteristics of it being high income people and condominiums and luxury rentals. It's a little different from what people are used to, but we built a pretty strong investor base of people that live around here and want to get in on this kind of strong market. And they're investing in our condo projects. So it made sense for us. We were building up a rental portfolio just with our own profit we were making from jobs. But obviously that's slow going. It's easier if you have investors involved. So we thought, why don't we get our investors involved with purchasing longer term assets, or apartments or things like that. So that was kind of an easy evolution for us. But when we get to the Southeast topic, we put a pause on the looking in the Southeast because we saw some data that I don't know. It's a little troubling to me anyways. It's the demographic data down there is extremely strong. Don't get me wrong. The population growth, the income growth, projected growth in the future, they're all great. But the cap rate compression has gotten a little out of control, in my opinion. So the cap rate compression, according to one study I saw, the Southeast as an overall region has now compressed below the Northeast, which to me doesn't make sense because the income levels of people living in the Northeast is still much higher. So I don't think that there's some sort of speculation going on there. And I don't know if that's a bubble or what it is. I might be wrong, but it just seemed it was throwing up a few red flags for us. And what we decided to do is keep this mentality of getting, into apartment buildings rather than just condominiums, but we're doing it in our backyard here. We're using the same sort of mentality that most people are using. We're looking for value add deals, and we're looking for places with really strong demographic data. We want to see strong population growth. We want to see income growth. We want to see crime rates going down. And you can find those in satellite cities outside of, we're in Boston, but if we look at some of the smaller cities in Massachusetts, those are extremely affordable alternatives to living in this. Like I was describing, all these high income workers flooding into Boston. What happens to people who are already living here, or just the regular people who are trying to move here? They have to live in these surrounding cities. They're more affordable. And that's what's happening all across the country. People are chasing affordability. So we're pursuing that apartment strategy right in our backyard. And we're adding a little bit of extra value with our development knowledge. What we're focusing on right now are office to apartment conversions, because there's a lot of underoccupied, underutilized office buildings that would be better served as apartment buildings.
Interesting. I didn't think about it initially, but that's great. If when you guys were doing both different models of the syndication and multifamily out of state and also development, you can utilize your same investor base. And now I just, as you said that, I was like, oh, this is fantastic, because usually I found it's easier with passive investors to be investing initially in something that's close to where they live or something where they're familiar with, which is usually similar. And then, bring in the projects that might be farther from home that you're also working on. So that's very interesting. When you're talking about, I think, people coming down to the Sun Belt and area like that to invest. And like you said, there's a lot of cap rate compression, and but it still doesn't have the income that you'd have in parts of New England. Where is your strategy to develop them, rent them, and or develop them and sell them? Because I think it's a completely different business plan, because myself being a landlord for 15 plus years in Connecticut, very tenant friendly state, that's different than selling, because you avoid a lot of issues after going through the red tape initially when you sell it. And just let me know what your thoughts are on that and how that works into your strategy.
Sure. Well, I'd say, we're very opportunistic guys. Our company, that's kind of our approach at Winter Spring Capital, is where's the opportunity? If we have some sort of knowledge in it, or we see someone else, kind of a peer of ours, if you will, doing something, we think we can do it. And that doesn't mean we know what we're doing. We'll bring in, experts, consultants. We'll talk with all the right people, try to learn as much as we can. So there's really no opportunity in the realm of real estate that we won't at least consider. And it's really, okay, where's the market going? Where's the opportunity here? As the red tape in Boston, for example, and the condo market continues to, wrap tighter or thicker, if you will, we're, trying to pursue some of these other opportunities. So to answer your question, we originally, we'd build and just sell condos. So we didn't have any assets to hold on to. Then we started to see, okay, to go up to some of these bigger projects and get, much bigger loans, you need to have a decent amount of assets on your balance sheet. So we started saying, okay, we got to figure out how these guys are in Boston, at least, are buying some land, building an apartment building, and, being able to hold on to it. And the numbers were it was tough for us to make that work, even though rents are pretty high in Boston. The NOI you'd get just kind of wouldn't support what you needed to make any money on the building. And the purchase price of the original parcel of land was just too high. So we started figuring out, okay, well, a lot of these guys are doing that. They're building and selling it like a 4 cap or something, selling their completed asset after they stabilize it. And, that's good enough. The debt to, the buyer is not really relevant. They're just looking at the NOI. We were looking at the whole picture. Okay, then we need to take out debt on this thing, and it'd probably be at like, 75% leverage, something like that, where it just wasn't really working. So we figured out kind of this office conversion opportunity could work for us, where we, redevelop it. We go in one of these satellite cities, we go in, we completely revitalize, bring it up to its highest and best use, have all these residential units, maybe keep some retail on the first floor that's existing already, work around them. So it's like a covered land play. We can bring in money as we're doing it. And then already have them set up, and get to the point where the value of the building we've created is a lot higher than what we owe the bank for the construction and the acquisition loan, where we can refinance and hold on to it. And so kind of what we're looking at that is, as far as our investors go, we're bringing in people who are used to our condo projects where they're paid, they don't receive anything for like 2 years, two and a half years. So they're kind of used to that. And, we incentivize them with higher returns for something like that, rather than regular distributions, which just isn't possible when you're building from scratch. There's nothing to distribute for a few years. So with the office play here, we're looking at, okay, it's going to be delayed gratification for the investors. But either way, whether we decide to hold it and refinance, by refinancing, or we decide to sell it at completion, we're going to pay back the investors a preferred rate of return at that point. And then what we do from there just kind of depends on the market. So like I started this kind of diatribe, we're opportunistic guys. So that's how we see it. We see going into this with 2 potential exit solutions. One of them, we would keep it. Either way, the investors are paid back at the refi, or we sell it. They're all paid back. And then we make, profit for our company that otherwise would have just remained as equity in the building.
One question on that, because you mentioned again the red tape. How is that? Where have I found before in a lot of these cities where you have a increased demand for residential, and the office to residential makes perfect sense, but I found some pushback before at levels of the city council and the government, because usually in a city your biggest expenses are education and police. So obviously they have to, they're adding in more rental units. The taxes for those units have to, pay for or subsidize the education for possibly children that are living in these places and stuff. Have you had pushback from like these city councils and governments about this conversion, or do they welcome it because they know they need more residential inventory?
Yeah, so it definitely depends where you're building. In Boston, they're lucky that they have people from all over clamoring to invest money and build in that city, because everyone understands the life sciences, the industry situation we were speaking about earlier. So there's a lot of investment, and the city can basically turn down most developers, be really stringent, and still come away progressing and building. Whereas when you're looking at some of these satellite cities, like the ones we're talking about for the office conversion, a lot of these cities are former, especially here in New England, a lot of them are former manufacturing hubs. Their population today is like equal to what it was in the late 1800s. So really they have the infrastructure and they have the desire to become a proper city again. And they've been doing a really good job over the past couple of decades, basically since Eric and I have been alive. We talk to our parents and we say, oh yeah, we're investing in Lowell. That's the name of the city. And they might go like, ooh, they might shudder and cringe and think, isn't that where, all the drugs are or whatever? But actually you look at it now today, the crime rate is below the state average. So a lot of these cities, they've been actively for several decades now on a campaign to improve and repopulate and clean up their cities. And they've been doing a really good job. And there's also all sorts of incentives from the state, like they have programs where they'll award you additional, basically a grant for your project if you invest in these what are called gateway cities. There's also tax credits you can get for a lot of these historic buildings. So there's a lot of things incentivizing developers to go in, and one of them is a friendly political environment. When we look at projects like this, one of the first things we do is we call the city planner and the people on the zoning board, and we talk with a local zoning attorney that's come from good references from brokers and other people in the real estate industry. And, what we heard for this project is come in, the thing that they were worried about is we build too much affordable housing because they already have too much of that. They want like nice high level rentals in their city. And I think that's an interesting point you made about how they'd obviously prefer homeowners for the taxes, but these people are still, they're going to be living right in the heart of the city. They're going to be patronizing local businesses. So they're still going to be contributing, pretty significantly to the economy. So I think the city's all for it. And, having the wind at our back is nice when we're used to dealing with Boston.
Yeah. The other thing too, though, is on it is when you're building high class enough, right? You're selling a condo for over $1 million. The chances are that their children are going to public school is probably not that high, right? You said you're selling for $600 a square foot outside of Boston. So you put those numbers together for a small, a medium-sized condo, let's say, that can get up into the 7 figures pretty easily. But very interesting on that. It's very true. Also, for anybody, it's like, listening is like developing, or if you're investing, just what Nick was saying with having the downward trajectory of crime in any of your cities and looking back at that. And before you even get involved with any city, speaking to the board, and that's even if you're buying a property that's already built that you're going to renovate or value add, just knowing how, making sure that the town, the city is on your side and not against you when you're trying to buy a property and, execute some sort of business plan that you've developed with your partners. But, so one other thing too, you guys have done that I haven't done before, and I'd like to learn more about it, is a lot of land entitlements. Can you explain what land entitlement is and how you utilize it within your business?
Yeah. So that's probably, our best skill set in terms of what we've done so far. And I describe land entitlement pretty simply as, taking a raw parcel or, an underutilized parcel or just any property and getting proper approvals to build something much more almost drastic there, much different, that really takes it to its highest and best use. So for example, you find a 2-family home in a 2-family zone, meaning the zoning laws say you can only build 2-family structures on that parcel of land and probably the surrounding ones. And you go through a long process that involves many steps, and then you get approved to build, a 10-unit building there. So that's kind of land entitlement in our case, especially. So that's almost an exact example of something we've done. So we'll find that, that very first project we both spoke about, the 2-family to 3-family, that zone with the zoning laws in Boston allowed for 3 units. We only had 2, so we didn't have to go through this long entitlement process to get, 3-unit a permit to build our 3 units. We had the plans, we applied. There's a small, back and forth. We got the permit. With something like what we typically do, what our business model does in a longer entitlement process is, okay, you find your land and you say, okay, there's, this is kind of what we do. And there's probably different approaches, but you find your piece of property, maybe it's currently a 1-family house, and you say, okay, this is in a 3-family zone. So I could right away, as long as I met the other dimensional requirements of the zoning code, such as, maximum height and the certain number of parking spaces and setback from the street and side yards and all that. As long as you met those, we could right away knock this down and build 3 units. Now there's some nuance there. The house might be deemed historical. All different cities have different sort of metrics that they use to say, okay, this is a historical piece of property or not. Boston, for example, if it's built before 1960, you have to go through a process to determine if it's going to be deemed historical. And they have 5 or 6 categories that they could deem it as. And one of them is essentially, we just deem it historical because we feel like it. And that's usually sort of what happens. Yeah. And then there's an additional process. So this is just the beginning when you're deciding, I want to demolish the existing house or building, whatever it is. You then have to go through a few month process where you kind of work with the historic committee and decide, it's called the Landmarks Commission, and decide if there's an alternative to demolition. And usually there isn't. It's like you could build off the structure, but usually, you know, the initial foundations may be very old. It almost never makes sense to do that. So they might say, okay, look, you know, we won't invoke a demolition delay on you, or they might. And then if they do invoke this demolition delay because you couldn't find an alternative and they deemed it historical, you have to wait 90 days to demolish. So that might be part of your entitlement process, or it might not. Concurrent, though, to that, you're going to start moving towards your building permit. And that process, if you're going to do 10 units, for example, on this fictional 2-family lot I'm talking about, there's many meetings. You have to meet with neighbors. You have to get neighbors on your side, local civic groups, local politicians. It's a very political process. Most people don't like you. They think you're coming in and ruining the neighborhood. Usually we're doing the opposite. We're finding a dilapidated, underutilized house or building or vacant building and bringing residents to the neighborhood who are going to pay taxes, and because these are homeowners in this example. So you go through this long process, and then eventually, you know, you kind of, maybe you went in with the 12-unit building, you come out with the 7-unit, you know, you kind of work to the neighbors and kind of met in the middle, because they say, no, 2-family zone, you're building 2 units. And we say, no, we're going to try to get variances to build 12. So you then, you know, throughout this process, you've brought in a zoning attorney to show you what variances you'll need. You brought in an architect, civil engineer, mechanical engineer to help design your plans. And they're always in flux as you go through the neighborhood process. So then once you're done with that whole process, which could take 6 months, it could take 24 months. It's really, sometimes you're really hated by the neighborhood groups. You got to keep going back. So this is all still part of this overall entitlement process that we deal with. So then we get to the point where we say, okay, this is our best shot. We have, 20 letters of support from neighbors. We hope there's not many letters of opposition. We don't really know. They've been sent into the mayor's office. We schedule a zoning hearing, go before the zoning board of appeals and say, okay, we want to build this 10-unit building on this piece of property. Here's, our case, our legal case. These are the variances we're seeking. In this case, it'd be number of units, number of dwelling units. And we need a variance since they only allow 2. We might need a variance on number of parking spaces per unit. Maybe they require 1, but there's no way we could really fit 10 on that property. Maybe we went a little closer to the street than we're allowed to, so we need a variance on setback. Yeah. So you'd list all your variances, you'd make your case, and then they would say, okay, they'll vote on it. It's a whole board. They'll agree. Okay, we'll grant you these variances. You can, you can go build this thing. And that's just sort of the start of the process. There's an appeal period after that where neighbors can appeal the decision. You can get sued, during that or at any point really. And then once you have your zoning board, ZBA, zoning board of appeals approved plans, then you start working towards your building permit. You have your architect draw up your full construction set. You submit that to the city along with all these other required documents. It seems like dozens and dozens of things. And then eventually you get your permit that says, erect 10 units. And that's kind of the entire entitlement process for us in a nutshell.
That's, very in-depth. I imagine you have multiple of these projects going on at the same time since they're so long-term. One question before we start wrapping up is, with that property, let's say that fictional or example, that 2-family, you have purchased that 2-family. You don't have it under contract or anything like that. You've actually purchased it at this point, and then you start the whole process. Is that correct? You're not tying it up or anything like this. You actually purchased it and then hoping that you can go, whatever it is, a 10 unit as we're talking here. Is that correct?
Could be. So we use a lot of different strategies. We're all about minimal risk. Obviously there has to be some risk, but we try to minimize it as much as possible for both ourselves and our investors. So if we have a project where we're going to go through this process and we purchase it outright, we have to have a plan B where if we run into trouble, then the letter of the law, you can build 2 units. We can still make enough profit to pay our investors back with their return and maybe, a little bit of profit for us. So we need a disaster scenario where we're not losing money. No one's losing money. Otherwise, we won't go after the deal. But what we also do is we do what are called zoning contingencies. So we'll write offers with a contingency that I'm not going to purchase your building today. I'm going to purchase it in a year or a year and a half once we have approvals. And for letting me wait that long, I'm going to pay you slightly above the market rate. So what would actually, like a pure land entitlement deal we just did was we got a property under contract with a zoning contingency. We didn't purchase it outright. We got it fully approved. Then before purchasing it, we found another developer because we have a lot of projects going on right now. We found another developer and we said, hey, we'll sell this building to you that we didn't even own yet, but we owned the approvals for because they were in our name. We'll sell this building to you. And that developer is now paying us, like 700, 800,000 more than we're paying.
Wow.
And that's the value that we generated just from getting those approvals.
Yeah.
And we have investors on that deal, they're going to be getting their money back instead of, 2 years, they're going to be getting their money back in a year because we're able to make so much profit just from entitling the land. We don't even need to do the construction. So it can be really valuable, especially in a place with that much red tape like Boston.
Yeah. No, that's just my question. If I was an investor, that'd be my question. What's your exit strategies? Because obviously this is just great going to the 10 unit, but obviously there's a lot of, as Eric went through, there's tons of different variables. So what are common mistakes you see real estate investors and developers make?
I think one of the things we see a lot is, and we started seeing this kind of with the Southeast deals we were talking about down there earlier with the cap rate compression, is overpaying. And now one thing, we were just talking about yesterday is there's a price you can overpay, where if the numbers still work, maybe it's like an off market deal or something, you can overpay in a sense because the numbers still work and it's the only way that you'll be able to take this deal down. But when you start chasing these things like cap rate compression going on down there, we were seeing deals where it was like you couldn't get a Fannie Freddie loan, you couldn't get any conventional financing. The only way it would work was if you had like a 3-year bridge and your pro forma numbers were at, those maybe produced 3 years out a good outcome, where you're almost taking a loss the first 3 years and you're going in at like a 4.25 cap. So we're going to see how a lot of those play out because we saw some of those purchased in the last year. I'm curious in the next year or two how those work out down there. But that I think's a big thing that always sticks out to us is really overpaying and chasing those deals that aren't going to perform for 3 years when there's plenty of other deals out there that you can be more creative about.
Right. Okay. What do you think are the main factors that have contributed to your success?
It's a combination of flexibility and always learning new things. So as Eric said, we're opportunistic. We started out in condo development. We have an affordable housing project right now. We're doing this office conversion, which involves like historic tax credits. We're constantly learning new things and looking at people who are a few steps ahead of us in one way or another and trying to see what they're doing right. And always asking the experts, speak with people. Don't try to Google it. Talk to people who've been doing it for 15 years.
Okay. And how can our listeners learn more about you and your businesses?
You can go to winterspringcapital.com. We're both on LinkedIn as well, Eric DiNicola and Nick Earls. We have an Instagram account, Winterspring Capital. And also Nick wrote a book on development. It's at winterspringcapital.com/development-book. It goes through our entire process, kind of shows you if it's something you wanted to start doing on your own and figure out. It really details everything for you, including that entire entitlement process I went through in much greater detail.
Okay. Awesome. Great. I will put those links into the show notes. So I want to thank both of you guys for coming on today and looking forward to connecting with you guys in the near future.
Thanks, Charles. Really appreciate it.
Absolutely.
Talk to you soon. Bye-bye.
Thanks,
Bye.
Charles.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.